So students, now come on to the page where rates of taxes in case of a capital gain is given. Over here we have already studied this section, that is section 112, rates of taxes in case of other capital asset. So now we will study rates of taxes in case of a equity share. So if this equity share is there, which is a capital asset, and these equity shares are of a company which are listed on a stock exchange, then how we will calculate the capital gain and how this capital gain will be taxable is given over here. Okay. Similarly, if these equity shares are of a company which are not listed on a stock exchange, then how we will calculate the capital gain, and on this capital gain how we will calculate the tax is given over here. I hope this is quite clear to you all. Okay. So now let's start with this listed part first. Okay. Rates of taxes in case of a equity shares of a company which are listed on a stock exchange. Point A says that if STT, that is security transaction tax, is paid on purchase and sales of such equity shares or units of equity oriented funds, then if there is a capital gain and such capital gain is a long term capital gain, then it will be taxable as per section 112A, that is beyond 1 lakh it will be taxable at the rate 10%. So understand that if a long term capital gain is derived of rupees say 3 lakhs, so from this 1 lakh will be reduced, and whatever is the balance, that is 2 lakh, it will be taxable at the rate 10%. I hope this is quite clear to us. But what if the assessee has derived a capital gain and it is a short term capital gain? So for example, a short term capital gain has been derived of say rupees 3 lakh on this listed equity shares. Okay, then on this 3 lakhs the tax will be calculated at the rate straight 15%. I hope this is quite clear to you all. Okay, so you know how to calculate the period of holding for this equity shares. Okay, but if you don't know, let's come back over here in types of capital gain where we have studied how to ascertain the period of holding. Okay, so basically understand this listed shares on recognized stock exchange. So what does this mean? If any equity shares are of a company which is listed on stock exchange, then these equity shares are known as listed shares on recognized stock exchange. So if this listed shares on a recognized stock exchange is a capital asset, then it falls in the range of 12 months. Okay, so if this listed shares are holded for a period of more than 12 months, then it will be considered as long term capital asset, and on this long term capital gain can be calculated or long term capital loss can be calculated. I hope this is quite clear. But if equity shares are of a company which are unlisted, that means the equity shares are of a company which is not listed on stock exchange, okay, then such equity shares, okay, will be known as unlisted shares, and this unlisted shares are the capital asset. Then in which range it will fall? It will fall in the range of 24 months. That means if this unlisted shares are holded for a period of more than 24 months, then it will be considered as long term capital asset, and on this long term capital gain will be calculated or long term capital loss will be calculated. I hope this is quite clear. But if this unlisted equity shares are holded for a period of less than 24 months, okay, then it will be considered as short-term capital asset, and on this short-term capital gain will be calculated or short-term capital loss will be calculated. I hope this is quite clear to you all. So over here, if the equity shares are of a company which are listed on a stock exchange, then the period of holding will be more than or less than 12 months. That is, it falls in the range of 12 months. I hope this is quite clear to you all. Okay, so let's understand this section first of all, that is section 112A. Okay, so come over here where section 112A is given in the notes. Okay, so let's understand this section now. Section 112A, long term capital gain on sales of listed equity shares or units of equity oriented funds or units of business trust, that is mutual funds only. Okay, if the shares are purchased and sold through recognized stock exchange, how to identify that whether the shares, that is this equity shares, are purchased and sold through a recognized stock exchange. Okay, so in order to identify that, I have given you a guidance over here how to identify that. So we need to check whether STT, that is security transaction tax, is paid on both purchase of this equity shares, okay, as well as at the time of the sale of this equity shares. I hope this is quite clear to you all. So let's read this part again. If the shares are purchased and sold through recognized stock exchange, then this section will be applicable, that is section 112A. Okay, how to identify that whether this section will be applicable. So check whether STT is paid on both purchase and sale of the security, that is this listed equity shares. I hope this is quite clear to you all. Exemption under section 112A is given of rupees 1 lakh maximum. Okay, beyond rupees 1 lakh, long term capital gain on sale of such unit, okay, this units of equity oriented funds or equity shares, that is the listed equity share, is taxable at the rate 10%. Okay, no indexation benefit is available for the cost of acquisition. I hope this is quite clear. How to calculate the cost of acquisition when we are applying section 112A, it is given over here. Okay, actual cost of acquisition of such listed equity shares we need to write. Okay, then we need to find out lower of the sales consideration, that is the sales value of such listed equity shares. Okay, and we have to compare it with the fair market value of such listed equity shares on the date, that is 31st January 2018. Whichever will be lower of this two will be considered over here, and whichever will be higher of this two, that means actual cost of acquisition, and whichever is lower of this two. For example, the amount came over here is 10,000 and actual cost is say rupees 5,000. Okay, then whichever is higher of this two, that is 10,000, the 10,000 will become cost of acquisition. I hope this is quite clear to you all. Okay, so how to calculate this fair market value as on 31st January 2018, that is what is given over here. Fair market value on 31st January 2018, how to calculate. Value of the shares on 31st January 2018 with entire day higher value if the share is listed and traded on 31st January 2018, that we have to consider. Don't worry, I'll explain you with the help of example. Okay, no rebate under section 87A is available if tax is calculated on the income which is taxable under this section, that is under section 112A. So come in a blank page over here. I'll give you an example over here. Understand this. Mr. A is the assessee. He has purchased Reliance Industries Limited shares on 1/7/2017 and has paid STT. Okay, he has purchased 1000 shares at the rate rupees 900 per shares. Okay, so that means the original cost of acquisition of the shares is 9 lakhs rupees. I hope this is quite clear to you all. He sold Reliance Industries Limited shares on 1st of June 2019, that is in our previous year 2019-20. I hope this is quite clear, and has paid STT when he has sold this equity shares. I hope this is quite clear. So he has sold his 1000 shares at the rate rupees 1500 per shares. I hope this is quite clear. So the full value of consideration, that is the sale consideration of this shares, is equal to rupees 15 lakhs. I hope this is quite clear to you all. Okay, so over here the question has said that the assessee Mr. A has purchased Reliance Industries Limited shares and he has paid STT at the time of purchase as well as he has paid STT at the time of sale. That means this assessee has purchased and sold this shares on recognized stock exchange. I hope this is quite clear to you all. So section 112A will be applicable over here. Okay, so one more detail I'll give and then I'll explain you the remaining part. Okay, the fair market value of Reliance Industries Limited shares on 31st January 2018 is as follows. Okay, the opening value of share is rupees 1400. The highest value of the share on this day is rupees 1450 rupees. The closing value of share on this day is rupees 1300. Okay, so which value we will select, that I'll explain it to you. Okay, don't worry about that. Okay, in order to understand this, come into the notes now. Over here, fair market value as on 31st January 2018 is written, and here the method of calculation is given. Okay, fair market value as on 31st January 2018, how to calculate. Okay, value of the shares on 31st January with the entire day highest value if the share is listed and traded on 31st January 2018, that we have to take. Okay, so come into the blank page over here again. So out of these three, which value we will select? We will select the value with the highest value of the share on this day. That means on 31st January 2018, whatever will be the highest value of this shares, that is Reliance Industries Limited, which was traded on the stock exchange. Okay, that we will consider. That means this value we will consider. I hope this is quite clear to you all. So in order to solve this question, come into the format book. Okay, over here the format of capital gain on listed equity share, how to calculate is given. Okay, so here we will write the name of the assessee. The name of the assessee is Mr. A. Okay, the residential status is not given. We will assume resident, ordinary resident. Period of holding. So let's come into the question. Over here the asset was purchased on 1st of July 2017 and the asset is sold on 1st of June 2019. So it is very simple that it has been holded for a period of more than 12 months. I hope this is quite clear to you all, because this is a listed securities and it will fall in the range of 12 months. I hope this is quite clear. So how to identify whether it is a long-term capital asset or a short-term capital asset? If the asset is holded for a period of more than 12 months, it is a long-term capital asset. If it is holded for a period of less than 12 months, it is a short-term capital asset. I hope this is quite clear. So in our case, this Reliance Industries Limited shares is a long-term capital asset. I hope this is quite clear. So come into the notes over here. Period of holding over here, we will write more than 12 number of months. Okay, and our capital asset is listed equity shares. I hope this is quite clear to you all. Okay, so we will mention full value of consideration over here. The full value of consideration is 15 lakhs. I hope this is quite clear to you all. So we will mention it over here, 15 lakhs. I hope this is quite clear to us. Is there any transfer expense given in the question? No, so we'll put a dash. The net consideration is equal to 15 lakhs. I hope this is quite clear to you all. Then we will reduce cost of acquisition. Since this is a listed equity shares, okay, so cost of acquisition will be calculated as per the formula given in the section, that is section 112A. Okay, so over here also in the format book this formula is given. Okay, so actual cost of as given in the question is 9 lakhs. We will mention it over here, 9 lakhs. Okay, and we will find out lower of this sales consideration and fair market value as on 31st January 2018. So the sales consideration is equal to 15 lakhs. 15 lakhs. Okay, so now we have to find out the fair market value of this listed equity share as on 31st January 2018. I hope this is quite clear. So as we have studied in the notes over here, the fair market value as on 31st January 2018 will be the value which is higher value of the entire day of this listed equity share which got traded on the 31st January 2018. I hope this is quite clear. So the value, that is the highest value of the share on the day of 31st January 2018 is 1450. I hope this is quite clear. So the fair market value as on 31st January 2018 is 14,50,000. How I have calculated this? 1000 into 1450. I hope this is quite clear to you. So out of this two we have to compare whichever is lower. So whichever is lower is 14,50,000. I hope this is quite clear. And 14,50,000 we have to compare with the actual cost of acquisition. Whichever is higher of this two, that is equal to 14,50,000. So cost of acquisition will become 14,50,000. I hope this is quite clear to you all. So we'll write over here 14,50,000 only. I hope this is quite clear. And our gross long-term capital gain will be equal to 50,000. I hope this is quite clear. So there are no details given about the exemption under section 54EE and 54F. We will put a dash over here. Okay, but before that there is one more thing given under section 112A, that if there is a long-term capital gain, okay, and such long-term capital gain is being calculated as per section 112A, then there is an exemption available up to rupees 1 lakh maximum. I hope this is quite clear. So up to rupees 50,000 this exemption will be available and long-term capital gain will be zero. I hope this is quite clear to you. So now we will change the value of fair market value in the question. Okay, so for example, assume that the fair market value was in this order: 1200, 1250 and 1100. Okay, so we would have taken this amount, the amount which is higher in the entire day on this day, that is 31st January 2018. So over here the value would have changed. Okay, it would have become 12,50,000. Okay, and this 12,50,000 would have been compared with this 9 lakhs. Okay, and the cost of acquisition would have changed and it would have become 12,50,000. I hope this is quite clear. And over here also it would have changed and it would have become 12,50,000. Okay, and the long term capital gain would have changed and it would have become 2,50,000. I hope this is quite clear. And there is an exemption available under section 112A up to rupees 1 lakh maximum. So this entire exemption we can claim from this gross long term capital gain. Okay, and there are no details given about this exemption under section 54EE and 54F. So we will put a dash over there, and our long term capital gain will be equal to 1 lakh 50. I hope this is quite clear. And on this 1 lakh 50 we will calculate the tax at the rate 10% flat. I hope this is quite clear to you. I hope you all have understood this thing. Okay, one more example we will solve. Okay, with this part also, bonus shares also. Okay, because many of the time students do a mistake over here, so I'll explain this bonus share part also. Okay, so don't worry. So for time being we will keep this example only and we will modify this example. Okay, cost of acquisition of this shares was say rupees 500 per shares. So the cost of acquisition will become 5 lakh. Okay, and it has been sold for say rupees 1000. Okay, so the full value of consideration will change and it will become 1 lakh. Okay, and the FMV of this shares on this date, that is 31st January 2018, will also change. We will change the figure. The opening value of the shares we will write 800. Okay, and the highest value, for example 850, and the closing value say 700. Okay, and one more detail I'll add over here, that is the company, that is Reliance Industries Limited, gave bonus shares to Mr. A. Okay, number of bonus shares given is 100 shares. Okay, and this bonus was given on 1st of December 2017. I hope this is quite clear to you all. So there is one more detail I have added. The company Reliance Industries Limited gave a bonus share to Mr. A and the number of shares given is 100 share. This bonus was given on 1st of December 2017. Okay, and one more thing I'll add over here is Mr. A also sold this bonus shares on 1st June 2019. Okay, so how we will calculate the capital gain on this, that also I'll show you. Okay, so now we will solve this entire sum. Okay, so the number of shares total sold by Mr. A is equal to 1000 normal shares. Okay, that is normal listed shares. Okay, plus 100 bonus shares. I hope this is quite clear to you all, and this bonus shares are also listed. I hope this is quite clear. So total number of shares sold is 1100. I hope this is quite clear. So full value of consideration will be equal to 1100 into what is the value of the shares are sold for. The shares are sold for rupees 1000 per share. Okay, so this is the market value. Okay, the shares are actually sold on stock exchange. I hope this is quite clear. So whatever is the value, that will be the only value for this bonus shares also. I hope this is quite clear. So we will write over here into 1000, this is rupees. Okay, so which is equal to 11 lakhs. I hope this is quite clear to you. Full value of consideration is equal to 11 lakhs. Okay, so now let's come into our format. Okay, we will write over here rupees 11 lakhs. I hope this is quite clear to you all. And is there any transfer expenses detail given in the question? No. So our net consideration will be equal to 11 lakhs only. Okay. And we need to find out our cost of acquisition as per section 112A. I hope this is quite clear. So over here, I have made a format for normal shares as well as for bonus shares. I hope this is quite clear. So the cost of acquisition of the normal shares is given in the question, which is rupees 5 lakhs. I hope this is quite clear. So we will mention it over here, 5 lakhs. I hope this is quite clear. Okay. And the cost of acquisition of this bonus share is 0 because it is given free of cost. I hope this is quite clear. Because in the question they have not given any detail. They have just simply said that the bonus shares are issued to our assessee, that is Mr. A, and bonus shares are just a way of capitalizing the profits. Okay. That is reserves and surplus. So the cost of acquisition of this 100 shares is 0 for Mr. A. I hope this is quite clear. I hope you all have understood this part. Okay. Then we need to find out this part, that is lower of sales consideration and fair market value as on 31st January 2018. So the sales consideration of 1000 shares, that is the normal shares, and 100 shares are available. That is, this 1000 shares are sold for rupees 1000 only each share. Okay. So it will be equal to 10 lakhs. I hope this is quite clear to you all. And this 100 shares are also sold for rupees 1000 per share. Okay. So the sales consideration of this 100 bonus share will be equal to 1 lakh. I hope this is also quite clear. So now we need to find out the fair market value as on 31st January 2018. So in our question, they have given us the detail of fair market value of the Reliance Industries Limited shares as on 31st January 2018. Okay. So the opening value of the shares is rupees 800. The highest value of the share on this date is 850 and the closing value of the share on this date is 700. So we will take this amount as fair market value of Reliance Industries Limited shares on 31st January 2018. I hope this is quite clear. So 1000 number of shares will be multiplied with 850. It will be equal to 8,50,000. I hope this is quite clear. And similarly, the fair market value of this bonus share will be multiplied with 850. Okay. So we will get 85,000 as the fair market value on 31st January 2018 for this bonus share. I hope this is quite clear. So whichever is lower of this two, okay, and whichever is higher of this two will be compared. So lower of this two is 8,50,000, okay, and higher of this two is also 8,50,000. So our cost of acquisition for normal share is 8,50,000. I hope this is quite clear to you all. So I'll mention over here cost of acquisition 8,50,000 plus we are going to find out cost of acquisition for this bonus shares also. I hope this is quite clear to you all. Okay. So over here we will again compare this 1 lakh with 85,000 and we will compare whichever is lower of this two with the actual cost of acquisition. So over here whichever is lower of this two is 85,000 and whichever is higher of this two, that is actual cost, and this 85,000. So whichever is higher is 85,000, that is the fair market value. So we will write over here 85,000. So the cost of acquisition of this total shares, that is the normal shares and the bonus shares, is equal to 8,50,000 plus 85,000, which is equal to 9,35,000. I hope this is quite clear to you all. Okay. So we will mention over here cost of acquisition as 9,35,000 and we will reduce it, okay, from 11 lakhs, okay, minus plus 11 lakhs, which is equal to 1,65,000. So this 1,65,000 is a gross long-term capital gain, and from this gross long-term capital gain there is an exemption available up to rupees 1 lakh maximum under section 112A. So we will reduce that also, okay. So we will reduce this 1 lakh. And there are no details given about the exemption under section 54EE and section 54F. So if there are no details given, we'll put a dash. And finally, our long-term capital gain will be equal to 65,000. And on this 65,000, we will calculate tax at the rate 10%, which will be equal to 6,500. I hope this is quite clear. I hope you all have understood this particular section, that is section 112A. So let's revise this section. Okay. Section 112A says that long-term capital gain on sale of listed equity shares or unit of equity-oriented funds or unit of business trust, that is mutual funds, will be calculated in this manner. That is, if the shares are purchased and sold through a recognized stock exchange, then this particular section will get triggered, and there is an exemption available under section 112A of rupees 1 lakh maximum. Okay. beyond rupees 1 lakh, long-term capital gain on the sales of this unit, that is units of equity-oriented funds or listed equity shares, will be taxable at the rate 10%, and cost of acquisition will not be allowed with indexation. So that is what is given over here, no indexation. But how to calculate the cost of acquisition if 112A is getting triggered? Okay, so the formula is given over here, actual cost of acquisition of the listed equity shares, okay, and lower of the following, that is sales consideration, which is full value of consideration of such equity shares that have been sold, okay, and it will be compared with the fair market value as on 31st January 2018. I hope this is quite clear. Whichever will be lower of this two will be compared with the actual cost, and whichever will be higher of the actual cost, and from this whatever the value has been derived will become our cost of acquisition for such listed equity shares. I hope this is quite clear to you all. But how to calculate this fair market value as on 31st January 2018? Fair market value as on 31st January 2018 will be calculated in this manner. Value of the shares on 31st January 2018 with the entire day high value if share is listed and traded on 31st January 2018. I hope this is quite clear. And no rebate under section 87A will be available if tax is calculated on income under section 112A. I hope this is quite clear to you. So let's understand this specific point. Okay, no rebate under section 87A will be available if tax is calculated on income under section 112A. So the rate of tax in case of an equity share, if such equity share is of a company which is listed on a stock exchange, then it will be calculated in this manner. If STT is paid on purchase as well as sale of such equity shares or unit of equity oriented fund, then if such asset is a long-term capital asset, then long-term capital gain will be calculated and the tax will be calculated as per under section 112A. So this is a special rate of tax, okay, given by Income Tax Act under the head income from capital gain. I hope this is quite clear to you all. Similarly, if this equity share, which is a share of a listed company, and this equity share, that is the listed equity share, is a short term capital asset, then short term capital gain will be calculated. I hope this is quite clear. And on this, tax will be calculated with the help of this section, that is under section 111A at the rate 15%. I hope this is quite clear to you all. Okay, but rebate on this will be available. I hope this is quite clear. So specifically I've written over here under section 112A that rebate is not available if tax is calculated under the section that is 112A. I hope this is quite clear. But rebate will be available on the short term capital gain which has been derived on this listed equity shares, and the tax has been calculated at the rate 15%. I hope this is quite clear. So for example, understand that, let's come into a blank page over here. Understand that Mr. A has purchased Reliance Industries Limited shares and paid STT, okay, and such purchase has been done on 1st of January 2019, okay, and the number of shares are 1000 shares, okay, at the rate rupees 500, okay. So the cost of acquisition is equal to 5 lakhs. I hope this is quite clear to you all, okay. And this shares are sold and STT paid on such sales, okay, on 1st of November 2019, okay, and this 1000 shares are sold at the rate rupees 700, okay. So full value of consideration is equal to 7 lakhs. I hope this is quite clear to you all. So as you can see from this example that STT is paid on the purchase of this Reliance Industries Limited and STT is paid on the sales also. I hope this is quite clear. So we need to firstly find out period of holding. So the asset is purchased on 1st of January 2019 and it is sold in the previous year 2019-20, okay, and the date is 1st of November 2019. That means the asset has been held for a period of 10 months, okay. So which means that it has been holded for a period of less than 12 months, okay. So this listed equity shares is a short term capital asset. On this, short term capital gain or short term capital loss can be derived. I hope this is quite clear. So let's calculate whether there will be short-term capital gain or there will be a short-term capital loss. So come into the format book. Okay, over here the format is given in case there is a short-term capital gain when there is a listed equity shares. I hope this is quite clear to you all. Okay, so we will write over here full value of consideration. Full value of consideration will be equal to 7 lakhs. Okay, so let's come back to the format book and we will mention over here 7 lakhs. Okay, there is no transfer expenses detail given, so the net consideration is equal to 7 lakhs only, and the cost of acquisition will be equal to 5 lakhs only. I hope this is quite clear, so we will mention over here 5 lakhs. Okay, so our short-term capital gain will be equal to 2 lakhs. I hope this is quite clear to you all. Okay, and since this is a short-term capital gain, on this tax will be calculated under section 111A at the rate 15%. I hope this is quite clear. That means 30,000 tax will be payable on this particular short-term capital gain. I hope this is quite clear to you all. So how we have derived that whether this particular section will be applicable for calculating tax. Okay, so here our chart comes into picture. If STT is paid at the time of purchase as well as sales, then even if there is a short-term capital gain, then there is a special rate of tax, that is under section 111A at the rate 15%. I hope you all have understood this much part. I hope this is quite clear. So now let's understand point number B. What does point number B says? That if there is an equity shares and such equity shares are of a company which are listed on a stock exchange, and if STT is paid at the time of purchase and the equity shares are sold privately without paying STT. Okay, so that means that the STT is not paid both the times, that is at the time of purchase and at the time of sale. Okay, so if the STT is not paid both the times, okay, then tax will be calculated in this manner. Okay, if the asset, that is the listed equity share, is a long-term capital asset, then long-term capital gain can be derived or long-term capital loss can be derived. But if long-term capital gain is derived, then it will be taxable flat at the rate 10% without indexation. Okay, and taxable flat at the rate 20% with indexation. So this is similar to what we have studied over here. Okay, I hope this is quite clear to you all. But what if this listed equity share is a short-term capital asset? Okay, and on this short-term capital asset, a short-term capital gain is derived. So how this short-term capital gain will be taxable? This short-term capital gain will be taxable as per the slab rate. If it is an individual, okay, who has gained this short-term capital gain, then it will be taxable as per the slab rate that we have already studied. But if the assessee is a firm, okay, or is a company, okay, then the tax rate is flat 30%. For company there are two tax rates, that is 25% and 30%. Whatever the rate will be applicable, it will be calculated on this short-term capital gain, and the tax will be payable on this short-term capital gain. I hope this is quite clear to you all. I hope you all have understood this chart. Okay, and now let's understand what if the equity shares are of a company which are not listed on a stock exchange. So same will be applicable over here. Okay, so what is written? If STT is not paid at the time of purchase and the equity shares are sold privately without paying STT, then the tax will be calculated in this manner. If there is a long-term capital gain, tax will be calculated in this manner. Taxable flat at the rate 10% without indexation. Taxable flat at the rate 20% with indexation. And if there is a short-term capital gain, it will be taxable as per the slab rate. I hope this is quite clear to you all. Okay, so I hope you all have understood this particular thing. I hope you all have understood this format also of listed equity shares. Okay, I hope this is quite clear. But for example, understand that if the capital asset is a unlisted equity shares, then which format we will use? We will use this format. Okay, because it is specifically written over here, format for capital gain on listed equity shares only. So even if the asset, that is the capital asset, is an unlisted equity share, okay, we will follow this format only. I hope this is quite clear to you all. So over here, one thing I want to mention over here is when we were computing short-term capital gain, over here I have not given any detail about exemption. Okay, because if there is a short-term capital gain on a listed equity shares, okay, then there is no exemption available under the Income Tax Act. That's why I have not given any detail about exemption. I hope this is quite clear. So this format will act as a last day revision for you. I hope this is quite clear to you all. Okay, so now let's revise rates of taxes in case of an equity shares where such equity shares are of a company which are listed on a stock exchange. Then point number A says that if STT is paid on purchase and sales of such equity shares or unit of equity oriented fund, then long-term capital gain if calculated on such equity shares, that is the listed equity shares, then the tax will be calculated as per section 112A. I hope this is quite clear to you all. But for example, if short-term capital gain is derived on this listed equity shares, then tax will be calculated as per this section, that is section 111A at the rate 15% on this short-term capital gain. I hope this is quite clear. Point B says that if STT is paid at the time of purchase and equity shares are sold privately without paying STT, then if there is a long-term capital gain, then the tax will be calculated on this long-term capital gain in this manner: taxable flat at the rate 10% without indexation, taxable flat at the rate 20% with indexation. Okay, but if short-term capital gain is derived on this listed equity shares when the listed equity shares were sold privately without paying STT, then short-term capital gain will be taxable as per the slab rate. I hope this is quite clear. Similarly, if the equity shares are of a company which are not listed, then the tax on this long-term capital gain and the short-term capital gain will be calculated in this manner. This tax rate is same only. I hope this is quite clear to you all. Okay, so understand this over here. Mr. A has equity shares of A Private Limited, okay, and the cost of acquisition of this equity shares in this A Private Limited is as follows. He has purchased 1000 equity shares at the rate rupees 100 per shares. Okay, so the cost of acquisition is equal to rupees 1 lakh. Okay, and he has acquired this equity shares on 1st of May 2016. I hope this is quite clear to all. And Mr. A has sold this equity shares on 1st of May 2019. Okay, and the full value of consideration is equal to say rupees 3 lakhs, and no STT has been paid. Okay, no STT has been paid both on purchase and sales also. I hope this is quite clear to you. So now let's calculate capital gain on such capital asset, that is unlisted equity shares. Okay, so we will write the name of the assessee. What is the name of the assessee? The name of the assessee is Mr. A. Okay, the period of holding, we will write simply POH. Period of holding is, let's calculate that. The asset was purchased on 1st of May 2016 and asset is sold on 1st of May 2019. Okay, so the period of holding can be easily seen as 3 years. Okay, and if the asset is an unlisted equity shares, okay, so this particular capital asset falls under the range of 24 months. Okay, since the period of holding is more than 24 months, this capital asset is a long-term capital asset. So we will write over here more than 24 months. Okay, so this is a long-term capital asset. I hope this is quite clear. So we will calculate long-term capital gain. Full value of consideration that the assessee has received on the sale of such capital asset is rupees 3 lakhs. I hope this is quite clear, and there are no details given about the transfer expenses, so we'll put a dash over here, and our net consideration will be equal to 3 lakhs. I hope this is quite clear to you. And now further we will reduce cost of acquisition or index cost of acquisition from this particular net consideration. Okay, so index cost of acquisition or cost of acquisition. So again we will make a 2 columns over here. Okay, 3 lakhs dash 3 lakhs. Okay, and the cost of acquisition given in the question of this particular asset is 1 lakh. Okay, so we'll write over here as 1 lakh first of all, and we will find out our gross long term capital gain, which is equal to 2 lakhs. Okay, and there are no details given about the exemptions. Okay, so we will put a dash, and finally our long term capital gain is equal to 2 lakhs. Okay, on this 2 lakhs tax will be calculated at the rate 10% because this is the method without indexation. Okay, so over here tax will be calculated at the rate 20% / 10% respectively. Tax is equal to 20,000. I hope this is quite clear to you all. So over here now we will calculate index cost of acquisition. Okay, so index cost of acquisition is equal to the actual cost of acquisition of the asset, that is equal to 1 lakh. Okay, and the asset is transferred in the previous year 2019-20, and the cost inflation index of the year, that is the previous year 2019-20, is equal to 289. Okay, so we need to find out the cost inflation index of this particular year, that is the financial year or the previous year 2016-17. Okay, so now let's come into our study material. Over here we will find out cost inflation index. Okay, cost inflation, wait, over here they have given us the details of cost inflation index. Okay, so let's come into our blank page again. This is for the financial year 2016-17. Okay, so the cost inflation index for the year 2016-17 is equal, for the year 2016-17 is equal to 264. Okay, so now let's come back to our blank page. Over here it will be divided by 264. So this amount is the cost inflation index for the previous year 2016-17. Okay, so let's find out the index cost of acquisition. So index cost of acquisition is equal to 1 lakh into 289 divided by 264, which is equal to 1,09,470. I hope this is quite clear to you all. So we will take this index cost of acquisition over here, 1,09,470. Okay, and finally our gross long term capital gain will be equal to minus plus 3 lakhs, which is equal to 1,90,530. I hope this is quite clear, and there are no exemption detail given. So this is the amount of long-term capital gain, that is 1,90,530. On this, tax will be calculated at the rate 30%. So on this 1,90,530 into 20% is equal to 38,106. Okay, tax is 20%. I hope this is quite clear. So which method we should follow? We should follow this method, that is without indexation method. Okay, because the tax liability is lower in without indexation method. I hope this is quite clear to you all. Okay, so I hope you all have understood how to calculate capital gain on listed equity shares. Okay, and as well as on unlisted equity shares. I hope this is quite clear to you all. Okay, so students, now we have already understood the rates of taxes in case of equity shares. Okay, but there was a concept that we have already studied under section 49. Okay, so let's revise that concept because it is in a similar lines of this equity shares only. Okay, so let's come on section number 49. Okay, and let's come on this point number 5, that is bonus shares. We have already studied this when we were studying this section number 49, but after studying the equity shares, okay, if we revise this bonus share, it will be very helpful for you all. Okay, so the period of holding for this bonus share will be calculated from the date of allotment of this bonus share to the assessee, okay, till the date of the sale. I hope this is quite clear to you all. If this bonus shares are of a listed company, okay, and if this bonus shares are holded for a period of more than 12 months, okay, then this bonus share will become a capital asset, that also a long term capital asset. I hope this is quite clear. If this bonus share is of a listed company, okay, and this bonus shares are holded for a period of less than 12 months, then this bonus share will become a capital asset, that also a short term capital asset. I hope this is quite clear to you all. Okay, similarly, if this bonus share is of a company which is an unlisted company, okay, then if this particular capital asset is holded for a period of more than 24 months, okay, then this capital asset will become long term capital asset. And if it is holded for less than 24 months, that means this bonus shares are holded for less than 24 months, then it will be considered as short term capital asset. I hope this is quite clear to you all. Okay, and we need to calculate the cost of acquisition for this bonus shares in order to calculate the capital gain. I hope this is quite clear. How to calculate the cost of acquisition? Okay, so it is given over here. If the bonus shares are acquired, that means the company has given this bonus shares after 1st April 2001, then the cost of acquisition of this bonus share will be nil. Okay, but if this bonus share is given by a listed company, okay, then we need to follow under section 112A's cost of acquisitions method. I hope this is quite clear to you all. Okay, but if this bonus share is of a company that is an unlisted company, then if this bonus shares are given to the assessee after 1st April 2001, then the cost of acquisition of such bonus share will be nil. But if the bonus shares are given by a listed company, okay, before 1st April 2001, okay, then the cost of acquisition will be fair market value on 1st April 2001, okay, and we have to find out the cost of acquisition as per 112A also, okay, so we will follow that method also, okay. But if the bonus shares are given by a listed company before 1st April 2001, then the cost of acquisition will be fair market value on 1st April 2001, as well as we need to follow the method of calculating cost of acquisition given under section 112A, okay. But what if this bonus shares has been given by unlisted company, okay, and such bonus shares has been given to the assessee before 1st April 2001, then the cost of acquisition of such bonus share will be equal to fair market value as on 1st April 2001. I hope this is quite clear to you all. Okay students, now come on to the page where section 50C is given. At the bottom there is one section, that is section 48. It is a small section, it will hardly take 5 minutes to understand, okay. So let's start with point number 2. What does point number 2 says? That indexation on shares. What does this shares mean? Shares means equity shares, okay. So if the equity share is a listed share, okay, then on such listed shares no indexation benefit will be available. We have already studied this under section 112A. I hope this is quite clear to you. But what if this equity shares is of a company which is an unlisted company? So this equity share will become unlisted shares, but on this unlisted shares indexation benefit is available. I hope this is quite clear to you all. So this particular indexation on the shares was given in this section, that is section 48. I hope this is quite clear to you all. Okay, so now let's move on to point number 3. Point number 3 says that security transaction tax paid is not allowed as transfer expenses. This particular point has a huge implication in practical life, okay. In exam I doubt they will ask such tricky question, but I'll explain you so that it will become easy for you, okay. So understand this over here. Mr. A has 1000 shares of Reliance Industries Limited, and Mr. A sold these shares on stock exchange and paid STT, okay. So the full value of consideration is equal to 1000 shares at the rate rupees 300 per shares. So the full value of consideration is equal to 3 lakhs, okay. But what happens in real life scenario is the broker gives a contract note, okay. So what is this contract note? The contract note is something that the assessee will get when he sells or purchases a particular security on a stock exchange. I hope this is quite clear. So over here the assessee is selling, okay, selling 1000 shares at the rate rupees 300 per shares, okay. So which is equal to 3 lakhs. I hope this is quite clear to you all. And the broker reduces STT at the rate 0.5% on this particular sales. So which is equal to 3 lakhs into 0.5%, which is equal to 1500, okay. And he reduces brokerage at the rate 2.5%. Let's calculate 2.5% on this 3 lakhs, okay. 3 lakhs into 2.5%, which is equal to 7500, okay. And finally a consideration is received by the assessee, that is our assessee Mr. A, in bank account, okay. So what is the final consideration received by this assessee? It will be equal to 3 lakhs minus 1500 minus 7500, which is equal to 2,91,000. So many of the time what the assessee makes a mistake is he takes this 2,91,000 as full value of consideration. No, the full value of consideration is 3 lakhs. I hope this is quite clear. So what we have to do is we have to calculate capital gain, okay. Assume that this particular capital asset is a long-term capital asset, okay. So we are calculating long-term capital gain, okay. So full value of consideration will be equal to 3 lakh, that is the value at which the asset was sold. So how many assets were sold? 1 lakh equity shares were sold at the rate rupees 300 per share. So the full value of consideration will be equal to 3 lakhs and not 2,91,000. I hope this is quite clear to you all. And further, we can reduce transfer expenses, and transfer expenses includes brokerage also. Okay, so brokerage of rupees 7,500 can be reduced from this full value of consideration, and finally we will find out our net consideration, which will be equal to 2,92,500. I hope this is quite clear to you all. Okay, so over here in section 48, what they have given is security transaction tax paid is not allowed as transfer expenses. So I hope you all have understood now what does this point was trying to say in section number 48 with the help of this example. I hope this is quite clear. Okay, I hope you all have understood this point number 3. Okay, so now let's understand point number 1. Point number 1 is least important at CA inter level. Okay, this is highly important at CA final level. Okay, so let's read this what it is. Non-resident who has acquired shares and debentures of Indian company and such is acquired by using convertible foreign exchange. Okay, then no indexation benefit is allowed. Only read this much, that is enough. Okay, do not analyze it right now at your level. Okay, only understand these 2 points. I hope you have understood this much. Okay, so students, now come on to the page where section number 47 is given. What is this section 47? Section 47 says that transaction not regarded as transfer. So basically at the start of this particular chapter, that is income from capital gain, we have studied that capital gain is triggered under section 45 subsection 1. Okay, when it get triggers when there is a capital asset as per the definition given under section 2 subsection 14, and plus this capital asset is transferred. Okay, and such transfer is as per the definition given under section 2 subsection 47. I hope this is quite clear to you all. So in this section 47, there are certain transactions which will not be regarded as transfer. So if a particular transaction is not regarded as transfer, then capital gain will not be triggered. I hope this is quite clear, irrespective if there is a capital asset. Okay, so let's understand this section, that is section 47. Okay, so let's understand point number 1. What does point number 1 says? That if an assessee is there and this assessee makes a transfer by way of a gift, will, inheritance or under any irrevocable trust to any person, okay, then such assessee who is transferring, it will not be considered as transfer and capital gain will not get triggered. I hope this is quite clear to you all. Then point number 2 says that transfer by HUF to its member, or if member transfer to its HUF on total or partial partition of HUF, then whatever the HUF has transferred to his member, it will not be considered as transferred. And similarly, if the members have transferred something to the HUF, it will also not be considered as transferred. I hope this is quite clear to you all. Okay, so let's move on to point number 3. Point number 3 says that transfer of a bond, GDRs, rupee denominated bonds by a non-resident to another non-resident outside India, then such transaction will not be considered as transfer. I hope this is quite clear. So understand this. This is our assessee who is a non-resident. Okay, and he is holding a bond. Okay, and he transfers this bond to another non-resident, and this all transaction happen outside India. Okay, so if it is happening outside India, then it will not be considered as transfer and capital gain will not get triggered. I hope this is quite clear to you. What does point number 4 says? Point number 4 says that transfer of work of art, archaeological collection, scientific collection, art collection, book, manuscript, drawing, painting, photograph, prints to government, university or a national museum or a national art gallery or a notified institution will not be considered as transfer. So understand this point number 4 in this manner. If a particular assessee is there and if it transfer the work of art to government or a university or a national museum or a national art gallery or a notified institution, then this assessee who is transferring this artwork will not be considered as transfer. I hope this is quite clear. Or if this assessee is transferring any of this, that is archaeological collection, scientific collection, art collection, book, manuscript, drawing, painting, photograph, prints or even this work of art to the government, university, national museum or a national art gallery or a notified institution will not be considered as transfer. I hope it is quite clear to you all, and I hope you all have understood how to interpret this point number 4. Okay. Then point number 5 says that transfer of a land by a Sikh industrial company. Okay, so understand this. There is this company, okay, and this company belongs to the Sikh industry. Okay, and if this company is transferring a land to any other person or any other assessee, then this company who is our assessee who is making the transfer of the land, okay, it will not be considered as transfer. And if the transfer is not considered as transfer, then capital gain will not get triggered. I hope this is quite clear to you all. Okay, and what does this Sikh industry means? Sikh industry simply means a particular industry, okay, which is performing very badly. Okay, I hope this is quite clear to you all. Okay, so now let's understand point number 6. What does point number 6 says? Transfer in case of a reverse mortgage scheme is also not considered as transfer. Okay, so what does this reverse mortgage scheme means? We need to understand it in a blank page. Okay, so let's understand it over here. Mr. X is a senior citizen. Okay, and this reverse mortgage scheme is only available to senior citizens only. Okay, this Mr. A is a senior citizen. Okay, and Mr. A is having a house property. Okay, and Mr. A is not having any source of income. Okay, so what he does is, this Mr. A mortgage his house property to a bank. Okay, and this bank, in return of the mortgage of the house property, gives this assessee a consideration lump sum consideration, or pays this assessee, that is Mr. A, on monthly or quarterly or half yearly basis. I hope this is quite clear to you all. Okay, so what is the scenario over here? Mr. A is a senior citizen. Okay, and he is having a house property. Okay, and he mortgages his house property with a bank, and this bank gives this Mr. A lump sum consideration. So here a consideration has been received by A, but what does section 47 says? If this kind of a transaction is done by the assessee and by the bank, then whatever a lump sum consideration has been received by the assessee, it will not be considered as transfer, and capital gain will not be calculated on this lump sum consideration. I hope this is quite clear to you all. Similarly, if the bank does not give the lump sum consideration, but the bank pays this assessee monthly or quarterly till the date this assessee dies, okay, then whatever this monthly consideration the assessee is receiving, it will be exempt. Okay, and it will be exempt under section 10 subsection 43. This lump sum consideration as well as monthly, quarterly or half yearly consideration that has been paid by this bank to the assessee will be exempt under section 10 subsection 43. I hope this is quite clear to you all. Okay, so that is what is given in this section 47, in this point number 6, which says that transfer in case of a reverse mortgage scheme will not be considered as transfer. I hope this is quite clear to you all. Okay, then point number 7 says that transfer of a shares of a special purpose vehicle to a business trust in exchange of a unit allotted by the trust to the special purpose vehicle is exempt. So what is this? This you will study at CA final level. Okay, but I'll give you a small glimpse about this particular thing. Let's come into a blank page. Understand that this is a mutual fund. Okay, so in order to run this mutual fund, a special purpose vehicle is been created. This special purpose vehicle is a company. Okay, this company borrows money, okay, and gives it to the mutual fund, and mutual fund in return gives the units of mutual funds to the special purpose vehicle. Okay, and whatever this transaction is taking place of transferring the unit, it is not considered as transfer. That is what is given over here in point number 7. Transfer of shares of a special purpose vehicle to a business trust in exchange of units allotted by the trust to the special purpose vehicle will not be considered as transfer. Do not stress on this. At your inter level, no questions will be asked from this. Okay, but at CA final level, the questions are going to come from this particular point. Okay, so let's move on to point number 8. What does point number 8 says? That transfer of a mutual funds unit by a unit holder in consolidation scheme of a mutual fund not to be regarded as transferred only if there is a consolidation of a one equity oriented scheme with another, or there is a consolidation of a one non-equity oriented scheme with another. So let's understand this also over here in the blank page. Understand that this is our assessee Mr. A, and he has 100 units of mutual funds. Okay, and this is a equity oriented mutual funds. I hope this is quite clear to you all. And this company in which he is holding the mutual funds, okay, this company is getting consolidated with another mutual fund company, and this mutual fund company is also an equity oriented mutual funds. Okay, so in return of this old 100 units, now Mr. A is receiving 120 units, okay, from this new consolidated mutual funds. Okay, so that is what is given over here. Transfer of a mutual fund units by the unit holder. So over here Mr. A was the unit holder of this 100 units. Okay, due to there is a consolidation of this mutual funds, a new units has been allotted to Mr. A, that is 120 units has been allotted. So if this is the scenario, it is not considered as transfer. I hope this is quite clear to you all. Okay, and here it is given that if there is a consolidation of one equity oriented scheme with another equity oriented scheme, then only this is not considered as transfer under section 47. Okay, but if one equity oriented scheme is getting consolidated with non-equity oriented scheme, then it will be considered as transfer. I hope this is quite clear to you all. Okay, I hope this is quite clear. Similarly, if there is a consolidation of one non-equity oriented scheme with another non-equity oriented scheme, then it is allowed. That means section 47 is getting triggered. That means it is not considered as transfer, and on this the unit holder do not need to pay capital gain. I hope this is quite clear to you all. Let's move on to point number 9. Point number 9 says that transfer of a sovereign gold bond issued by RBI by any individual to another will not be considered as transfer. I hope this is quite clear. So let's understand point number 9. What does point number 9 says? Transfer of a sovereign gold bond issued by RBI by any person to another person or another SSC, okay, will not be considered as transfer. So understand this. There is this SSC who is holding gold bonds, okay, that is gold sovereign bonds, okay, and he's giving, that is he's transferring this bond to any SSC. Okay, so he's transferring this capital asset, okay, but this transfer is not considered as transfer. I hope this is quite clear. So capital gain will not get triggered. I hope this is quite clear. So that is what is given in this point number 9 under section 47. I hope this is quite clear. Okay, so now let's move on to point number 10. Point number 10 says that transfer of a capital asset by a holding company to a subsidiary company or a vice versa. What does vice versa means? If there is a transfer of a capital asset by a subsidiary company to a holding company, is also not considered as transfer, okay, as per section 47. But there are certain conditions. Okay, so what are the conditions? Let's read it over here. Provided following conditions are satisfied, holding company should be an Indian company and holding company should hold 100% shares of the subsidiary company. Let's understand it in a blank page over here. Understand that this is ABC Private Limited company. This is the holding company, okay, and it is holding 100% shares in XYZ Private Limited company. Okay, so if this ABC Limited is transferring any capital asset to this XYZ Private Limited, then it will not be considered as transfer, okay, and there will be no capital gain. I hope this is quite clear. Similarly, if this subsidiary, okay, if this subsidiary is transferring any capital asset to this holding company, it will not be considered as transfer and there will be no capital gain. I hope this is quite clear to you all. So that is what is given over here in point number 10, which says that transfer of a capital asset by a holding company to a subsidiary company or a subsidiary company to a holding company, provided following conditions are satisfied, that is holding company should be an Indian company and holding company should hold 100% shares of a subsidiary company. I hope this is quite clear. Over here, this company, that is ABC Private Limited company, should be an Indian company, okay, and this subsidiary can be a foreign company also. That is not a problem. I hope this is quite clear to you all. Let's come back to the notes again, okay, and let's understand point number 11. What does point number 11 says? Transfer by the amalgamating company to the amalgamated company under the scheme of amalgamation, provided amalgamated company is a Indian company, then also it will not be considered as transfer. I hope this is quite clear, and capital gain will not get triggered. So what is happening over here? Understand this over here. This is ABC Limited, okay, and this is XYZ Limited, and these both companies are getting amalgamated. That means ABC Limited is getting amalgamated into XYZ Limited, okay. So basically this is amalgamating company, or in other words we can call it as old company, and now it is getting amalgamated in this XYZ Limited, which is amalgamated company, okay, which is a new company. I hope this is quite clear. So whatever the transfer has been done by this old company to this new company will not be considered as transfer. I hope this is quite clear, and no capital gain will get triggered. I hope this is quite clear. Now let's move on to point number 12. Point number 12 says that transfer of the shares being capital assets of the amalgamating company by the shareholders of the amalgamating company under the scheme of amalgamation, provided amalgamated company is an Indian company and such transfer is made in consideration of the shares allotted in the amalgamated company. I hope you all have not understood a single word, because this is quite a complicated line item. Okay, so let's understand this. So over here, what was the scenario? ABC Limited was the amalgamating company and it got amalgamated in XYZ Limited, that is amalgamated company, which is a new company. Okay. So here in this old company, there will be shareholders. Okay. So these shareholders will receive new shares of XYZ Limited now. Okay. So that is what is given over here. Transfer of shares being capital assets of amalgamating company by the shareholders. So understand this over here. These are the shareholders, and shares of ABC Limited are the capital asset of the shareholders. Okay, so what they are doing, the shareholders of ABC Limited are transferring its shares to the XYZ Limited, and in return they are receiving the shares of XYZ Limited. So that is what is given. Transfer of shares being the capital asset. So the old company's share, that is the amalgamating company's share, is the capital asset of the shareholders, and the shareholders are transferring the capital asset of this amalgamating company under the scheme of amalgamation, provided that the amalgamated company is a Indian company and such amalgamated company is giving the shares of new company, that is the amalgamated company, to the shareholders, then it will not be considered as transfer. I hope this is quite clear to you all. I think it is quite complicated at your level, but it is given in your syllabus, that's why I'm explaining it to you all. Again, I'll explain you. So this is the old company and this is the shareholders of the old company. Okay, and these shareholders are holding the shares of ABC Limited. Okay, so there is an amalgamation between these two company. Okay, ABC Limited and XYZ Limited. Okay, so ABC Limited will give its old share to this XYZ Limited, and in return will receive new shares of XYZ Limited. Who will receive? The shareholders will receive, right? So the shareholders were holding this shares. Okay, so now they will not hold this shares. They are transferring this shares, and in return they are receiving new shares of XYZ Limited. Okay, provided this XYZ Limited, that is the amalgamated company, is an Indian company. Okay, and this amalgamated company is giving a new shares to the shareholders of the old company, then these shareholders will not need to calculate capital gain. I hope this is quite clear to you all now. Okay, so I hope you all have understood this point number 12 now. Transfer of shares being the capital assets of the amalgamating company holded by the shareholders of the amalgamating company under the scheme of amalgamation, provided amalgamated company is an Indian company and such transfer is made in consideration of the shares allotted in the amalgamated company. I hope this is quite clear to you all now. So now let's understand point number 13. What does point number 13 says? Transfer by a demerger company to a resultant company in a scheme of demerger, provided resultant company is an Indian company, then such transfer will not be regarded as a transfer. So let's understand this. This is a company, it has 4 units, and this 4th unit is getting demerged. Okay, and it will form a resultant company. Okay, and if this unit forms a new company, it should be an Indian company. Okay, then whatever the transfer has been done by this old company to this resultant company, okay, will not be considered as transfer. Okay, and on this no capital gain will be calculated. I hope this is quite clear to you all. So now let's move on to point number 14. What does point number 14 says? Transfer of a shares being the capital asset of a demerger company by the shareholders of a demerger company under the scheme of a demerger, provided resultant company is an Indian company and such transfer is made in consideration of a shares allotted in the resultant company. So this is similar to this point number 12 that we have studied. I hope you don't need an explanation for this point number 14. Okay students, so now let's move on to point number 15. Point number 15 is important at CA final level. Okay, if I want to explain you this particular point at your level, it will take at least minimum 10 to 15 minutes. Okay, and this particular concept will not be asked at your inter level. Okay, so even if you skip this part, it is okay, but if you want to understand this, you read it 2 to 3 times, you will understand it. Okay, but if I explain it, it will take a lot of time, so let's skip it. Okay, let's move on. And let's move on to the next point, that is point number 16. What does point number 16 says? Transfer by the previous cooperative bank to a successor cooperative bank in the scheme of business reorganization, then such transfer will not be considered as transfer. So understand this, there is an old bank, okay, and this old bank is getting converted or getting reorganized with a new bank, okay. So here whatever the transfer has been taken place between the old bank, okay, and the new bank, okay, then this will not be considered as transfer, okay, and this old bank will not need to calculate capital gain. I hope this is quite clear to you all, okay. So that is what is given over here in point number 16. Transfer by the previous cooperative bank to a successive cooperative bank in the scheme of business reorganization, then such transfer will not be considered as transfer. Okay, so now let's move on to point number 17. Point number 17 says that transfer of a shares being a capital asset of a previous cooperative bank by a shareholder in the scheme of business reorganization, provided if such transfer is made in consideration of the shares allotted in a successor cooperative bank, then such transfer will not be considered as transfer. I hope this is also quite clear because we have already understood this point number 12. It is on the similar lines to point number 12. If you want to understand it again, rewind the video to this point number 12 and understand it. I hope this is quite clear to you all. Okay, so now let's understand point number 18. Point number 18 says that transfer of a sole proprietary concern business to a company will not be regarded as transfer if following conditions are satisfied. Here what is getting transferred? Here a sole proprietary business is getting transferred to a company. So this will not be considered as transfer as per section 47. I hope this is quite clear. So what is the condition? Let's understand the condition. All the assets or liability of a sole proprietary concern, that is the business, becomes the assets and liability of the company, and the sole proprietor becomes the shareholder of the company for not less than 50% of the shareholding, and it continues for a period of 5 years from the date of conversion, okay. And the sole proprietor does not receive any other consideration benefit from the company other than the shares of the company, whether directly or indirectly. So what does this point says? Let's understand it over here in a blank page, okay. So understand this. This is a sole proprietary business, okay. Sole proprietary business, and the assessee wants to convert this business into a company, okay. So over here the transfer is taking place, okay. This transfer will not be considered as transfer under section 47 if following conditions are satisfied, that is, all the assets and liability of the sole proprietary concern become the assets of the company, okay. The sole proprietor becomes the shareholder of the company for not less than 50% of the shareholding, and it continues. That means the sole proprietor, who is the shareholder now in the company, continues to hold the shareholding for a period of 5 years from the date of conversion. Then only this transfer will not be regarded as transfer under section 47, okay. And the sole proprietor does not receive any other consideration benefit from the company other than the shares of the company, whether directly or indirectly. I hope this is quite clear to you all. Okay students, so now let's understand point number 19. What does point number 19 says? Transfer of a capital asset by a partnership firm to a company will not be regarded as transfer. That means a partnership firm is getting converted into a company, then it will not be considered as transfer if these following conditions are satisfied, that is, all the assets and the liability of the partnership concern becomes the asset and liability of the company, and the partnership firm becomes the shareholder of the company for not less than 50% of the shareholding, and it continues for a period of 5 years. That means the partnership firm, that is, all the partners hold the 50% shareholding in the company for a period of 5 years from the date of the conversion, and all the partners become the shareholder in the same portion in which their capital account stood in the firm before the date of the conversion. I hope this is quite clear to you all. And the partnership firm does not receive any other consideration benefit from the company other than the shares of the company, whether directly or indirectly. I hope this is quite clear to you all. So whatever points that has been given on this page, okay, is very important. First of all, this may come in MCQ, okay. On this particular point, a practical question to be framed is something very difficult at your CA inter level, okay. So read this particular points as a theory, okay. Do not read it as a practical. Okay, so now let's understand point number 20. What does point number 20 says? Transfer of a capital asset by a private limited company or an unlisted company. In simple word, a private limited company or an unlisted company is getting converted into a firm or LLP, then it will not be considered as transfer. If following conditions are satisfied, that is all the assets and liability of the company will become the assets and liability of the LLP or the firm, and all the shareholders of the company becomes the partner of the LLP, and the share and their capital contribution and the PSR in the LLP are in the same portion as their shareholding in the company on the date of conversion, and no consideration other than the shares to the shareholder, and aggregate shareholding shall not be less than 50%. Okay, and the turnover in the three previous preceding previous year shall not exceed 60 lakhs. The shares in the three previous preceding previous year shall not exceed rupees 5 crore. I hope this is quite clear. So don't worry about this. You just need to study all this in a form of theory. Okay. So study it in a theory manner. Do not expect a practical question on this. Okay. This section, that is section 47, will maximum come in MCQ. Okay. There is hardly a possibility that they will ask a theory question on this. Okay. Or they will ask a practical question on this. I hope this is quite clear to you all. So students, now come on to page where section 50B is given. Section 50B stands for slum sale. What is this slum sale? Let's understand this first of all in a blank page. Over here there is a company, ABC company. This ABC company is having this unit. Okay, ABC company developed, or we can say started, a new unit, that is unit A, in the year 2016. That is on 1st of April 2016. Okay, and in the year, that is the previous year 2019-20, ABC company has decided to sell of this particular business unit to XYZ company. Okay, this business unit has been sold to this XYZ company. So over here, this particular unit is a capital asset of this company, and this company is transferring this capital asset, okay, to this XYZ company. Okay, so capital gain will get triggered. How capital gain will get triggered, how we will calculate capital gain, and how the tax will be calculated on this capital gain is given in this section, that is section 50B. Okay, so over here the period of holding we need to determine. Okay, the period of holding will be determined as per 36 months. Okay, if a particular unit has been holded for a period of more than 36 months, okay, then such unit will be known as long-term capital asset. Or else if this particular unit has been held for a period of less than 36 months, then such unit will be known as short-term capital asset. Okay, and on this particular capital asset, that is the unit, if the assessee derives a short-term capital gain, that is if the asset has been held for a period of less than 36 months, then the tax will be calculated as per the slab rate. But if the asset, that is our capital asset, which is our unit, is a long-term capital asset, and on this long-term capital asset a long-term capital gain has been derived, that means the asset has been holded for a period of more than 36 months, then the tax rate on such long-term capital gain is 20% flat. I hope this is quite clear. How to calculate the capital gain now? Okay, over here I have made a format in the notes itself which says net consideration, refer working note number 1, which will be reduced by the net worth, which will become our working note number 2, and finally we will calculate our long-term capital gain if the asset is a long-term capital asset. So how to calculate net consideration? To calculate net consideration, it is very simple. Full value of consideration, which will become our sales consideration over here, and further we will reduce transfer expenses related to such lump sale. Okay, that will become our net consideration. Okay, in exam this all details will be provided to you. You just need to simply calculate this net consideration, and then you need to calculate the net worth. This is the important task. How to calculate net worth? Net worth is equal to total asset minus current liabilities. I hope you know how to ascertain a particular liability is a current liability or not. Okay, so what does total asset means? Total asset means depreciable asset at the rate WDV, other asset at the rate book value. If asset on which depreciation is allowed but not claimed, so claim depreciation and consider the figure over here, and whatever will be the total will be taken over here as total asset, and further it will be reduced by the current liabilities, and that will become our net worth. And finally we will find out our long-term capital gain or a short-term capital gain. So let's understand this particular thing with the help of an example. Understand this. There is a company. Okay, this company is having A unit and B unit. Okay, in A unit there are total assets of say rupees 50 lakhs, and in B unit there are assets of 100 lakhs. Okay, and in unit A, there are total liability of say rupees 30 lakhs, and in unit B there is a total liability of 60 lakhs. Okay, so now we come to know that in this company, this particular unit number B is going to be sold. Okay, so we need to calculate the net worth of this unit number B. So the net worth of this unit number B will be equal to 40, and this unit number B, if is sold for 100 lakhs, okay, and there is no transfer expenses, then this will become our net consideration. Okay, and we will further reduce the net worth, okay, which is 40, and finally we will find out our capital gain, that is equal to 60. Okay, so this was a layman understanding that I gave to you. So now let's understand it with the help of a proper example. Okay, so understand it in this manner. There is a company having two units, A and B. Okay, so there is a detail given about the unit A and unit B. Let's see that particulars. A and B: debtors, fixed assets, inventory, cash, machinery. I hope this is quite clear. And there are details given about liabilities also. So equity, shares, loan, current liability. I hope this is quite clear. Let's put the figure. Debtor is 10 over here, debtor is 20 over here, fixed asset is 30 over here, fixed asset over here is 60, inventory over here is 50, inventory over here is 30. Okay, cash over here is 2, cash over here is 4, machinery over here is of 40. Okay, and over here machinery is of 80. Okay, and on this machinery depreciation has been not calculated, so we need to calculate depreciation. So now let's find out the total assets. Okay, total assets is equal to 97. Okay, and for the unit B is 20 plus 60 plus 30 plus 4 plus 80 is equal to 194. I hope this is quite clear to you all. Over here equity shares is of 50 lakhs. Okay, and loan is of 20 lakhs and current liability is of 27 lakhs. Over here equity is of 100, loan is of 40, and current liability is of 54. I hope this is quite clear. And total liability is equal to 97 is equal to 194. I hope this is quite clear. And this company wants to sell off this unit number A. So how we will calculate the capital gain on this? Okay, so basically this unit number A was started in the year 2017, that is 1st April 2017. So the period of holding of unit A is equal to 1st April 2017 to 1st April 2019, because this unit A is being sold on 1st April 2019. So over here we can see that the period of holding is 24 months, okay, which is less than 36 months. Okay, so this unit is a short-term capital asset. So we need to calculate the capital gain over here. Okay, so let's assume that the sales consideration of this unit A is unit A is 120 lakhs. Okay, and transfer expenses is reduced from this sales consideration, and we need to reduce the transfer expenses. So let's reduce the transfer expenses. Let's assume that the transfer expenses is of 10. Okay, so our net consideration is equal to 110 now, and we need to reduce the net worth, okay, in order to calculate the short-term capital gain. I hope this is quite clear. So let's calculate the net worth. Okay, so for calculating the net worth, what is the formula given? Total assets minus current liabilities. Okay, so what does total assets means? Depreciable asset at the rate WDV, other asset at the rate book value. If asset on which depreciation is allowed but not claimed, then we need to claim depreciation. I hope this is quite clear to you all. So now let's calculate the total assets value. Okay, so let's come to our question over here. Let's see the total assets. Okay, so over here debtor we will consider in calculation of the total asset. Total asset. We will consider this fixed asset also in the calculation of the total asset. We will consider inventory also, cash also, and machinery also. On this machinery, depreciation has not been claimed, so we have to find out the depreciation. For time being, I am giving you the depreciation figure of rupees 10. Okay, so we need to reduce this 10 from this 40. So let's calculate the total asset. Debtors, which is equal to 10 fixed asset, which is at WDV only. So we will mention that figure of 30 over here. Inventory, cash, machinery. Okay, so inventory is given in the question as 15, cash is 2, and machinery is 40. But depreciation has not been claimed for the earlier years, so we need to claim it now. Okay, so it will become 30. So let's total this off. The total will come to around 87. I hope this is quite clear. So now let's calculate the total current liability. I hope this is quite clear to you all. Okay, so let's come into the question. Here the details are given: equity shares, loan, current liability. They have specifically given us the current liability, and they have not given any detail about this loan. So we can assume anything. We can assume this loan as current liability, or we can assume this as non-current liabilities. I hope this is quite clear. So we are assuming in this case this loan as current liability. Okay, we are not assuming this as non-current liability. So the total of current liability is equal to loan 20 and current liability 27, which is equal to 47. I hope this is quite clear. So the net worth is equal to total assets minus total current liability, which is equal to 87 minus 47, which is equal to 40. I hope this is quite clear. So we will take this 40 over here. Okay, and we will calculate a short-term capital gain, which is equal to 70. I hope this is quite clear. On this 70, tax will be calculated at the rate slab rate. I hope this is quite clear. Since this was a company, the slab rate will be 30% or 25%. I hope this is quite clear to you all. So this was our concept, slum sale. I hope this is quite clear to you all. Okay, so let's revise this section, that is section 50B, slum sale. Short-term capital gain if the unit is held for a period of less than 36 months, and on such short-term capital gain, tax will be calculated as per the slab rate. Okay, and if the unit is held for a period of more than 36 months, and if a long-term capital gain has been derived, then it will be taxable at the rate 20% flat. I hope this is quite clear. Format for calculation of the capital gain is net consideration reduced by net worth. We will find out our long-term capital gain or short-term capital gain, and it will be taxable. I hope this is quite clear. How to calculate net consideration? Sales consideration, that is full value of consideration of the sale of the unit, which will be reduced by the transfer expenses if any, and we will find out our net consideration. I hope this is quite clear. Then we will calculate the net worth. Okay, net worth will be calculated in this manner: total asset minus current liability. I hope this is quite clear. How to calculate the total asset? Depreciable assets WDV will be taken. Okay, other assets book value will be taken. If asset on which depreciation is allowed but not claimed, so we will calculate the depreciation and we will claim the depreciation, and we will put the value of the asset after claiming the depreciation. I hope this is quite clear. And we will find out a total asset, which will be further reduced by the total of current liability. I hope this is quite clear. Wait, I'll write over here total current liability. I hope this is quite clear to you all. And there is a note: revaluation to be ignored if the question gives WDV as per the Income Tax Act. I hope this is quite clear to you all. So at times the question will try to confuse you by giving you the revaluation figure, but in that question only there will be WDV of this depreciable asset. So only follow this part, that is the WDV as per the income tax given in the question. Do not get confused with the revaluation part. I hope this is quite clear to you all. Okay students, so now let's understand our next section, that is section 51, forfeiture of advance. What is this forfeiture of advance? Okay, let's understand first of all this in a layman term. Here our assessee is there, Mr. A. Mr. A has a house property, and this house property he wants to sell at the rate rupees 30 lakhs. Okay, Mr. A got a prospective buyer, that is Mr. B, who wants to buy this house property, okay, at the rate 30 lakhs. But he does not have entire 30 lakhs right now. In order to secure this house property, Mr. B gave Mr. A an advance of rupees 1 lakh for such house property. I hope this is quite clear to you all. And Mr. A accepted that advance of rupees 1 lakh. and he made an agreement with Mr. B that he will not sell this house property. That means Mr. A will not sell this house property to any other person other than this B. Okay, but after some time, Mr. B came to Mr. A and told him that he cannot pay remaining amount of 29 lakhs. Okay, so what does Mr. A does? Mr. A forfeits the entire advance of rupees 1 lakh. What does forfeit means? He will not return this advance of rupees 1 lakh to Mr. A. So if the assessee, that means Mr. A, is forfeiting the advance that he has taken for the sale of the house property, then what will be the treatment as per the Income Tax Act? Will it be considered as income or what? That is what is given over here in this section, that is section 51, forfeiture of advance. So let's understand this chart. If a forfeiture of advance is done by the assessee before 1st of April 2014, then what has to be done? Then if the forfeiture is done by the assessee, then such forfeiture has to be reduced from the cost of acquisition, and we need to calculate index cost of acquisition. I hope this is quite clear to you all. But if such forfeiture is done before 1st April 2014 and such forfeiture is done by the previous owner, then we need to ignore the forfeiture. So what does this mean? Let's understand this part first of all. So let's understand this over here. Mr. A had a house property and he wanted to sell this house property for rupees 30 lakhs in the previous year 2013-14. Okay, and he found a buyer, Mr. B. Mr. B gave an advance of rupees 1 lakh. Okay, but Mr. B did not honored the agreement. Okay, so Mr. A forfeited the advance money of rupees 1 lakh. I hope this is quite clear to you all. Okay, and the cost of acquisition of this house property of Mr. A is rupees 5 lakh, and he has acquired this house property on 1st of May 2006. I hope this is quite clear to you all. Okay, so what is the scenario over here? The scenario over here is Mr. A had a house property. He wanted to sell a house property for rupees 30 lakh in the previous year 13-14, and he found a buyer, Mr. B, and Mr. B gave an advance of rupees 1 lakh, but Mr. B did not honor the agreement. That means he did not pay the remaining balance of 29 lakhs. So Mr. A forfeited the advance money of rupees 1 lakh, and the cost of acquisition of this house property of Mr. A is rupees 5 lakh, and this house property was acquired in the year 1/5/2006. Okay, now again in the year, that is previous year 2019-20, Mr. A wants to sell the house property for rupees 60 lakhs. Okay, so how we will calculate the capital gain amount? So see over here. Firstly, the full value of consideration will be equal to 60 lakhs, assuming that it is as per the stamp duty valuation only. Okay, so we will write over here 60 lakhs less transfer expenses. There are no detail given, so we'll put a dash, and this will only become our net consideration. Okay, and now we will reduce index cost of acquisition or cost of acquisition from this net consideration. I hope this is quite clear. So while calculating index cost of acquisition, how the things will be done? Okay, so while calculating index cost of acquisition, we will write over here cost of acquisition, right? So here we will not write the actual cost of acquisition, that is this rupees 5 lakh. We will reduce this 5 lakhs with the forfeited advance of rupees 1 lakh, and then we will calculate the indexation. I hope this is quite clear. That means the cost of acquisition will not be 5 lakh, it will be 4 lakhs into 287 divided by whatever the cost inflation index is of this year, that is the year when the property was purchased, that is the previous year 2006 and 7. I hope this is quite clear to you all. So that is what is written over here. If a forfeiture of an advance is done and such advance is done before 1st April 2014. So in our question, the forfeiture was done in the year 2013 and 14. That means maximum up to 31st March 2014, this forfeiture would have already been done. That means the forfeiture was done before 1st April 2014. I hope this is quite clear to you all. Okay. And the forfeiture was done by the assessee. Okay, that's why such forfeiture of amount was reduced from the actual cost of acquisition and then indexation was calculated. But similarly, if the house property, that means for example Mr. A tried to sold this house property in 2013 and 14, okay, but he could not sold and he forfeited a particular advance. But what he did later is he transferred this house property to his son, that is Mr. B. Okay, so if Mr. A is transferring the house property to Mr. B, okay, and the previous owner, that is the Mr. A, has already forfeited an advance, then it will not affect the assessee, that is Mr. B. He do not need to reduce this forfeiture of advance from the cost of acquisition, but this cost of acquisition can be taken from the previous owner only, that is Mr. A. I hope this is quite clear to you all. Okay, so let's revise only this much part. Section 51, forfeiture of advance. If it is done before 1st April 2014, then if it is done by the assessee, then whatever is the forfeiture of advance, it will be reduced from the cost of acquisition and then we will calculate index cost of acquisition. But if this forfeiture is done before 1st April 2014 by the previous owner, then we will ignore this forfeiture of advance. Okay. But what if this forfeiture of advance is done after 1st April 2014? Then whatever the amount of forfeiture has been done by the assessee, it will be taxable under the head income from other sources. I hope this is quite clear. So let's come to our note over here. Understand that this particular advance was forfeited in the year 2014 and 15. Okay, that means after 1st April 2014, then this entire rupees 1 lakh would have been considered in the head income from other sources as income. I hope this is quite clear to you all. I hope you all have understood this part, and here our chapter income from capital gain comes to an end. I hope this is quite clear. Okay.